During times of uncertainty like this, it's nice to have a dividend cash cow just laying around in your barn. A cash cow is an asset that will continue to provide cash flow over its lifespan. In today's example, I will go over two brand new dividend stocks that I have never covered before and show how greatly shareholders would be rewarded holding on to these dividend cash cows. The first cash cow stock is an amazing brand in Honeywell, which is a diversified technology and manufacturing company. They invent and commercialize technology in the areas of energy, safety, security, air travel, software, among many more sectors. Taking a look at their website, it would be impossible for me to list everything that they are actually involved in for such a short video. But a conglomerate like this reminds me of another cash cow with red and white colors, 3M. Although they may be hurt in the short term here, like every other company, Honeywell has just too many products that will always be needed. For example, they make the N95 masks, which are so critical for the safety of people right now. Recently, they just reconfigured a plant where they were typically making safety glasses and face shields, located in the state of Rhode Island, to also be making N95 masks, which are high in demand. The US also executed the Defense Production Act recently and is now paying Honeywell $27 million to build N95 masks in their government contract. Last year, they had over $4 billion in sales contracts with the US government, mostly related to their aerospace industry. I like having the US government as a buyer because they have a printing machine that never runs out of ink. Honeywell is also an international presence, with about 40% of its sales in 2019 coming in Asia and Europe. Honeywell also licensed its brand name to retail products made by other manufacturers, such as thermostats, alarm systems, fans, air conditioners, and much more you've probably seen around the household or at the local store. Looking at their income statement, it shows some fluctuations of revenue ranging from $37 billion to $42 billion over the last 5 years. I usually like to see this just go straight up every year, but being in a cyclical industry like this, I understand the fluctuations. They currently have close to $12 billion in long-term debt, but with total assets of $59 billion, I wouldn't worry too much about that. And that's what really sticks out about this company is that they have over $9 billion in cash on hand. That would be enough to cover its interest expense 77 times. It was also just able to secure a $6 billion loan, giving them even more liquidity and insurance during tough times if they so need it. All right, let's get to the part that you really want to hear about, those sweet dividends. Honeywell paid out $2.5 billion in dividends in 2019 and currently trades at a starting yield of 2.71%. While that might not sound too juicy, remember that wealth is built over a long period of time. So let's see how Honeywell was faring in the year 2000. 20 years ago today, Honeywell was trading for $53.62. So if you bought them, you got a whole 75 cents in dividends for the whole year, which is about just a 1.4% dividend yield. Now, if you had just held on to those shares and done nothing else other than let the fine folks at Honeywell continue to create innovative products and services that we need in everyday life, you would have been rewarded very heavily over the years. As now Honeywell trades at the time of this recording for $132, representing a 290% return with dividends reinvested. Keep in mind the S&P 500 during the same time period, and I'm saying only in air quotes, returned 175% during that same time span. But the true beauty here is the yield on cost. Honeywell now pays out $3.60 a share. We bought our shares in 2000 for $53. So while throughout the years Honeywell has increased that dividend and its stock price has fluctuated, our cost basis has never changed. Meaning our yield on cost today is an amazing 6.7% for doing nothing but holding on to our shares. This is really the true superpower of dividend growth investing. While Honeywell has paid out dividends for many years, it hasn't consistently increased it every year till 2004 when they first started increasing it. With a near 14% 5-year growth rate, expect that yield on cost to go up even quicker this decade, as I have no doubt that Honeywell will become a dividend aristocrat. Also, don't miss out on this opportunity. If you guys are liking this content, please be sure to hit that like button and subscribe to the channel for more videos. This is the best way you can support a small-time YouTuber like me who spends a lot of hours trying to make these videos for you guys. And doing so also lets me know these are the type of videos you want to see more of. So the next stock isn't as exciting, but that doesn't mean it can't be as profitable. That would be Genuine Parts Company, ticker symbol GPC. This organization distributes automotive replacement parts, industrial parts, and materials throughout the world. You've probably heard of their subsidiary, Napa Auto Parts, which has over 6,000 locations and some pretty interesting commercials.
Now, one word, merchandising. The Chase Elliott seat cover with massaging beard action. Your face is giving the massage.
Are you serious?
The Chase Elliott dipstick. Dip like a pro.
You know you're big time when you got your own dipstick.
Every time someone opens their car, hey there, maybe check your oil.
No.
Founded in Atlanta, Georgia in 1925, the company went public in 1948 and has been paying dividends every single year since then. In fact, what makes this relatively small company of only a $10 billion market cap so special is that they have a very impressive streak of increased dividends. For 63 straight years, since 1957, they have not only paid a dividend, but they have increased it every year as well. Think about all the events that have taken place, different presidents, their administrations, different wars, technological changes, rise of the internet, smartphones. Throughout all this, the company has found a way to keep thriving. Even in times of normal, non-pandemic recessions, people need their car to be running and they need it to be serviced so they're able to travel places. Although Tesla might be the electric car company to beat today, I'm sure other companies will one day close that mark, meaning more of the parts on those electric cars will become more uniform, meaning Napa should have parts for them and they can perform repair services as well. In fact, GPC had record sales in 2019 of over $19 billion and almost $600 million in free cash flow. They do have a little less than $4 billion in long-term debt and only $300 million of cash on hand, which is not enough to comfortably pay their dividends of $438 million in 2019. But do expect GPC to find some way to keep their dividend streak alive and be able to cut costs whenever they can. Now for the exciting part, those sweet dividends. Let's imagine we've owned GPC for 20 years and see how we've fared. 20 years ago, GPC was trading for $25.25, and they had an annual dividend of $1.10, or about a 4.35% starting yield, which is actually already a pretty good starting yield to begin with. But in the 20 years since, this company has done just phenomenal, with 455% total return. That's 2.5 times that of the S&P 500's return over the same time period. And this is, of course, all with the dividends reinvested. So today's ending price will give you a 188.71% return from just capital appreciation. But let's take a look at that yield on cost. So we take what GPC now pays in dividends, which is $3.16, by our starting price, which has never changed, of $25.25, for a whopping yield on cost of 12.5% for doing nothing but holding on to this dividend king. I think this just shows that you don't always need to be a flashy company coming out with the hottest technology. Sometimes the tried and true method is good enough to grow rich. Now, the best way to increase that yield on cost is to hit that subscribe button to keep seeing videos that I put out onto the channel. So let me know if these are two stocks you are considering buying. I would love to hear you guys' feedback in the comments. And as always, be sure to like the video for the algorithm, and it also helps me know if these are the type of videos you want to see in the future.